fundsupermart.com.
Hello everyone. In early May, the State Council announced the new 9 directives. How will this affect the Chinese bond market? Today we have Jessie Lam, Executive Director and Head of Distribution Channels of CSOP Asset Management, to share with us her views. Hi Jessie, thanks for joining us. In early May, the State Council announced new 9 directives, which covers interest rate liberalization and the reform of the renminbi exchange rate regime. What does that imply for investors of renminbi products?
Right. What the 9 directive states is it provides us with a very good framework about what the government would like to do in terms of its development of the capital markets. And over the years, we can see that basically the debt and credit and the loan rate has been completely opened up. So it's freely flowed. And even the governor of the PBOC also expressed to the market that they are expecting the interest rate to be completely liberalized. All these are evidence of a tremendous achievement of the liberalization of the interest rate markets. Well, back to the exchange rate fund, we already see the announcement of the increasing daily band of the renminbi fluctuation from 1% to 2% around this April. A lot of people will start to worry. What we see is the increasing liquidity, volatility, as well as the cross-border activity of renminbi as a currency. The ultimate aim is to improve the cross-border transaction of renminbi. In order to achieve its long-term goal is to make it an internationalized currency. So the short-term fluctuations is something that normal. We will be seeing a lot more development in terms of new product coming out to the renminbi-related types of products, either through the fixed income market or as well as the A-shares markets. So what investor in general can expect is more product innovations, and at the same time, comparing to the rest of the world, the current yield and the potential return that can offer from the A-shares as well as the onshore fixed income market are much higher than the rest of the world.
The new 9 directives have brought forward further developments of the bond market, including improvements on the local government debt system. How will the onshore bond market be affected?
Right. The local government debt market has always been a concern to a lot of people, including Chinese governments. It was only until a few years back, by 2009, the government started to offer some kind of pilot scheme allowing certain types of provincial government to issue debt to raise funding to finance their local projects for urbanizations, development, things like that. Now the government started off allowing certain types of provincial government to raise debt through the fixed income market, as well as allowing them to reissue it to continue the development of their projects. And in June, we see a successful case, like the Guangdong government has successfully raised about 14.8 billion in its local government debt to continue its local development. So this is evidence that the government is serious about changing the structures of the local government debt systems. What does it mean to the onshore fixed income market? Ultimately, this will be gradually replaced by the genuine local government debt that comes out over this pilot scheme. And for those, we will expect to see the yield to start to stabilize. And of course, there will be a bipolar development in terms of the rate offered by different provincial government because of the financial standings and the development of the infrastructures, the balance sheet, and so on and so forth. In short, we will see more product innovations as well as a diversity in terms of the yield offered by different local governments. And on top of that, we will also expect to see more development from the private side. So that will enhance further the development of the credit market as a whole. So we will see more diversity in terms of sector offering, as well as the yield spread will be widened in the onshore fixed income market over time.
In view of the current circumstances, what is your outlook on the Chinese onshore bond market going into the second half of the year?
Right. Basically, we are still very positive in the onshore fixed income market. If we look at it from the macro perspective, we already see some sign of progress in the economic figures comes out recently, both in April and May. So we should be expecting relatively neutral towards some easing in terms of the monetary policy, but at the same time we have to keep an eye on the development of the property sectors as well. And if we look at the policy side, the government this time around will not focus on across the board either easing or tightening of its liquidity. Instead, it will be very focused. Like in April and in June, we see 2 times round of the targeted easing, which is quite different from what they did in the past. So these are very supportive to the continuous bull run, so to speak, in terms of the fixed income market that so far we've seen in 2014. And if we look at it from a strategy perspective, what we will see is with the local government that continue to develop, in the short run, we will still focus more on the interest rate, interest policy, primarily for a longer duration, which still offer better yield and with a lower risk profile. And for the credit front, we will focus on high quality credit bond with a 3 to 5 year duration, with the average quality of AA plus or above. This will be our focus in the rest of 2014.